The new I-bond interest rate is out. So today we're going to explain what I-bonds are and why even though the interest rate is half what it was last year, now might be the best time in the past 15 years to buy I-bonds.
Right. So I-bonds are inflation protected bonds issued by the US Treasury. And the real benefit of these is that the interest rate that gets paid to you is going to adjust with inflation. So it's a really great inflation hedge long term. And if you do want to buy them, you do have to go to treasurydirect.gov to purchase them.
Yeah, and I-bonds have been on a roller coaster. They were unknown a few years ago. Then they really peaked in the fall of last year when they were paying over 9% in terms of people's interest and in interest they pay. But now really could be a great time to buy them because again, they're right now paying 4.3%. And that is made up of a combination of a variable rate of 3.4% and then a fixed rate of 0.9%.
Right. And so this rate's going to be locked between May 1st, 2023, all the way through October 31st of 2023. So it's important to note that that fixed rate of 0.9%, that's going to be fixed throughout the duration of the bond itself. So that is not going to change. So you're really locking that rate in.
Yep.
It's going to be that variable piece that's going to go up and down with inflation rates over time.
And they announce that variable rate each May and then August.
So how is that fixed rate calculated, Peter?
The theory is it does move potentially based off of the real yields of treasuries. So if you do overlay I-bonds, fixed rate, and treasury yields, you will see some correlation there, but it's not a one-to-one correlation. Nobody really knows.
No, but there is a correlation like you said, and that fixed rate really does kind of protect you against what's called deflation. So again, it's the opposite of inflation. So if we enter into an era, which is pretty rare here in the US, an era where inflation goes all the way down to zero and then dips negative, deflation, those are usually periods during recessions, economic growth is really negative, then you will be protected. So your variable rate can go negative, but the Treasury has made a deal with you saying that your total interest paid out to you is not going to go below 0%.
Yep. And then you'll still have that fixed rate. So this is where people loved I-bonds last year. They're paying over 9%, but there was no fixed rate. So all of those people's I-bonds, they adjust each 6 months and you get the new variable rate and you get to maintain whatever fixed rate you have. So it is worth looking at. Do you, if you're not somebody that's buying more I-bonds, because there's some limits we're going to go over in a minute, but do you potentially redeem old I-bonds to buy a new one and actually get this fixed rate because you're earning almost 1% above inflation. And that's everybody's goal, is to beat inflation with investments. That's why you invest in real estate or stocks. You're trying to beat inflation. These new I-bonds actually have that feature. So it's pretty interesting. And again, they haven't had this much of a fixed rate for the past 15 years.
Yeah. So while inflation was a lot higher last year when a lot of people kind of rushed into these I-bonds and bought them, it's almost 1/3 of the rate of what it was last year. So it's a very interesting question. Do you actually sell out of your current I-bond, give up 3 months worth of interest to actually buy this new one? I think it is.
And lock in a fixed rate for the eternity of the bond.
Yeah, I think if you tend to hold this thing for the long term, it's definitely a decision you should make.
And interest works differently on an I-bond than, say, your bank account, right? So I-bonds pay interest monthly and it compounds semi-annually, so 2 times a year, and it will compound on that bigger value. So they take the interest that's been paid out for 6 months and then your interest builds on top of that.
So let's talk about taxes. I-bonds are actually a very tax efficient vehicle. So you get a very nice tax deferred tax break on that. And then any state or local income tax on that is going to be completely tax free.
So you can elect when you buy them to defer all the taxes. Even though you're getting interest paid monthly, it's not added to your taxes like you're having to pay on it like a bank account would. Once you redeem the I-bond, then all of the taxes are due. So it does defer the taxes.
It's a little bit like an IRA or a 401k.
Yeah,
we
it's
can
just
defer
like
all
that.
of that.
Yeah, and like interest compounding, it does help eke out a little bit more gains potentially because you're deferring taxes.
Yeah.
And potentially as well, if you do use the I-bond funds and proceeds for higher qualified education, they can potentially all be tax-free. So it is a potential college savings vehicle that can give you complete tax-free growth.
Yeah. So what happens if I want to sell my I-bond early? Because remember, whenever you buy these I-bonds, these are supposed to be 30-year instruments.
Yeah.
And let's say after year 2, year 3, you want to actually sell out of it. What happens?
Can't do anything within 12 months. So you don't want to buy an I-bond unless you're for sure able to hold this cash for 12 months. Between 12 months, so 1 year and year 5, if you want to redeem it, cash it out, you have a penalty of the last 3 months of interest. So whatever that interest is at the time, that variable rate, you're going to lose those last 3 months in the fixed rate. Something to pay attention to. A lot of people buy I-bonds, I think, just thinking, hey, whatever that variable rate is, if I need the money, I lose the last 3 months, and they try to still say, okay, maybe this is still higher than what I'm getting in cash anyways, even if I lose 3 months.
It's not that bad of a
It's a small penalty, but yeah, it's important to know these are designed to be 30-year investments, but most people still treat them as kind of a few-year investment. And if they lose 3 months, whatever, no big deal.
And after 5 years, you can sell them without any penalty whatsoever.
Yep.
So it's just like any other liquid bond. You sell it and you're good to go. You get your principal back.
Yep. But there are these purchase limits, and this is what's tricky to determine if I-bonds are worth it depending on each investor. So per Social Security number, you can buy $10,000 worth of I-bonds each year. You can if you have a spouse, they can. Kids can get an I-bond if that makes sense. A business can get an I-bond. Trust can get I-bonds. So if you have different entities, this can actually add up between you and a spouse and a business and a trust, etc. And if you have a federal tax refund, you can apply $5,000 of that to buy more I-bonds. So that's the only way you get above that $10,000 number is from a tax refund.
So technically 15, but realistically 10,000. At least 10,000 electronic form. So the paper method with a refund, that's the extra $5,000. So if you get clever with it, you and your spouse and your kids and your business, if you have one, and then if you have a trust, I mean, you can actually start to add these things up and get some decent inflation protection.
Even though it's got that 1 year limit, you keep stacking them each year, you can build it up, and then you've got some inflation protection. But who do you think these are right for, right? You've got restrictions, you've got purchase limits. Who makes sense to get I-bonds? Somebody that has a short-term cash goal, longer than 1 year, probably shorter than a few years though, so you're probably expecting you're going to lose some interest.
No,
right?
I mean, realistically, it's somebody like that, right? You're locking up your money, so you're giving up some type of liquidity. So if you need your money within a year, definitely keep it in cash. Don't buy CDs, don't buy I-bonds, don't buy treasuries, just keep it in a liquid account.
Put it in a high yield savings account.
Get to it anywhere. But let's say, like you said, like this is going to be like a year 1 to maybe year 3 type of time horizon. Then obviously that's going to be more suited for, hey, I'm trying to save money for a down payment on a house. Or I have a big purchase, I want to buy a car in a few years.
And I want some inflation protection, which a high yield savings account isn't offering you. Great. A little bit of money might make sense for an I-bond, and doing the math already, saying, hey, even if I lose 3 months of interest, I'm still going to end out better by doing this than putting in a savings account. Because high yield savings accounts are now paying 4 to 5%. T-bills are paying 5-ish%, but those don't have any fixed rates, and those can fluctuate, right? If you buy a 4-week T-bill, in 4 weeks, you're getting whatever the rate is. You buy an I-bond, you at least have that fixed rate.
And this is a great time to actually lock in that fixed rate.
Yeah, that's why it's so appealing, even more so than the ones in the past. Net worth probably drives a lot of this. If you have a really high net worth, I-bonds probably aren't worth the return on hassle of opening up an account, going through the website. For $10,000, some people, $10,000 will be a huge amount of money. Do it. Other people, $10,000 is a rounding error to their net worth, and they're probably not going to go through the hassle of dealing with opening up an account to buy I-bonds.
But yeah, I mean, it's definitely worth considering. It doesn't take long to actually go through the clunky website, treasurydirect.gov, and actually open one of these up. And then once you buy it, you're good. You locked it in. Thanks for watching. Again, my name is Ryan, this is Peter, and we run a financial advisory firm called Bull Oak Capital. If you want to learn more about how we help our clients achieve true financial independence, be sure to check out bulloakcapital.com.